Welcome to DevTech Finance. In this video, we will be learning about types of mutual fund. This video is a part of mutual funds tutorial, so I recommend you to watch all other related videos to get a better understanding on this topic. Let's start with the types of mutual fund. So here we will be referring to 5 major categories classification. First is based on structure. We will be learning about open-ended fund, close-ended fund and interval fund. Based on asset class, mutual funds are categorized as equity fund, debt fund and hybrid fund. Based on goals, we are having tax saving fund, retirement fund, growth fund and fixed income fund. Based on risk, we can classify as low risk fund, moderate risk fund and high risk fund. Based on speciality, we will be having sector fund, thematic fund and fund of fund. So we will be learning in brief about all these types of mutual fund. Now this becomes important that as an investor you must be aware about these particular mutual fund schemes, because whenever you are going to invest in any mutual fund, you know that it is subject to risk because it is linked to investment in market securities. Now you need to consider your risk appetite, your investment objective, and you must be aware about all the types of mutual funds so that you can choose the appropriate one as per your demand, as per your investment goal. Now let's start with first one based on structure. Open-ended fund. Open-end schemes are open for investors to enter or exit at any time even after NFO. So these are mutual fund schemes which are always available for you for subscription or redemption. Subscription is whenever you are purchasing any mutual fund scheme. Redemption is whenever you are selling any mutual fund scheme. So open-ended fund are always open for your subscription or redemption to any mutual fund scheme. Now these schemes are open even after NFO. It means that NFO is new fund offer. Whenever AMC, which is asset management company, which can be any bank or financial institution, whenever they launch any new mutual fund scheme that is available for investors for subscription, that time period is called new fund offer period. So for that time period, it is like a new mutual fund scheme available for you to invest. But after that period is over, even after that, if you can invest, you can enter or exit from that particular scheme at any time. So those schemes will be referred as open-ended fund. Although some unit holders may exit from the open-end scheme wholly or partially, the scheme continues operations with the remaining investors. So one particular mutual fund scheme will be having many investors. So all those investors will be investing their money in that particular mutual fund scheme. Now, even if some investors have redeemed their mutual fund scheme, they have gone for redemption, it means they have sold their mutual fund schemes. Even after that, those mutual fund schemes will continue. So, these are referred as open-ended fund. The scheme does not have any kind of time frame in which it is to be closed. Now, second is close-ended fund. Now, when you will be learning about close-ended fund, it will become more clear the difference between the two, open-ended fund and this one. So, closed-end funds have a fixed maturity. Investors can buy units of a closed-end scheme from the fund only during its NFO. So, as an open-ended fund, we saw that even after NFO, the scheme was open for investors to purchase or sell the mutual fund units. But in close-ended fund, it is not available after NFO. So it is only during the NFO. NFO we learned about new fund offer. So whenever new fund scheme is launched in the market, so for that time period, it is available for purchase or selling of the mutual fund scheme. But after that, these close-end schemes, after that it becomes closed and it is listed in the stock exchange. So if you are an investor in close-ended fund and you want to go for redemption, you want to go for subscription of any scheme, you want to go for purchase or sell of any mutual fund scheme, you will have to visit the stock exchange and you will have to do trading over there. So close-ended funds are only available during the NFO period, that is new fund offer period. After that, it becomes listed on the stock exchange. So after that, you will be trading as investor. You will be buying and selling if the investors will be available. The trading investors will be available over there. This is done through a listing of the scheme in one or more stock exchanges. Such listing is compulsory for close-ended schemes. So listing of these funds on stock exchanges is compulsory because once they become closed and you are not able to purchase or sell from mutual fund scheme, it becomes important to create a platform where trading could be done. And this is the reason why it is listed on stock exchange, where you can trade easily, where you can purchase or sell your mutual fund units, the units of close-ended funds which you own. Third type is interval fund. Interval funds combine features of both open-end and close-end funds. They are largely close-end but become open-end during pre-specified time periods. The gap between two successive transaction periods is called interval period. The minimum duration of an interval period is 15 days. Subscription and redemption is not permitted during the interval period. Okay, so you must be understanding that interval funds are having a combination of both open-end and close-end funds. So they are largely close-ended funds, which means that after NFO they are not available, they are closed, but they are open for a specified time periods. So this time period, the minimum duration could be so these are available after a specified time period. Now the gap between two successive transaction period is called interval period. So the gap between when the fund become closed and when it again opened for purchase and sale, that gap, that time period gap is called interval period. And this interval period minimum duration should be 15 days. So for 15 days it will remain closed minimum, but it can be more than that. Now, during the interval period, during the period when it is closed, the subscription and redemption is not permitted. It means you cannot purchase or sell your mutual fund scheme units. So you will have to wait for the period when it will again become open-end, when it will be opened for a specific time period, and at that time you will be able to sell your scheme or purchase any new scheme. So this is interval fund, which will be having the feature of both open-ended and close-ended. Now second is on the basis of asset class. Equity fund, the fund that invests in equity and equity related instruments. So those mutual fund schemes which are riskier, which are investing in equity and equity related instruments largely. So it will be more than 65% of your investment amount will go into equity instruments. Now some examples are small cap, mid cap and large cap equity funds, where investment is made in shares of companies on the basis of their market capitalization. So whenever you come to hear about small cap fund, mid cap fund or large cap funds, these are funds investing in those companies which are having their market capital, which are having small market capitalization, medium and large market capitalization. And to give you a brief about market cap, it shows the value of company that is traded, which means that it is calculated by multiplying total number of shares by price of each share. So that will be the market cap of any particular company, the total number of shares trading in the market and the price of each share. So according to that, small cap fund will be investing in those companies which are categorized as small cap, which means which are having lesser market capitalization. And in the same way, large cap fund will be investing the major amount in those companies which are having large market capitalization. Now the risk involved in these funds are higher, hence the expectation of return by investors are also high. So we know that the risk and return criteria, it is like if we are taking higher risk, we are expecting higher returns. And thus, because in equity funds, they are taking risk, the expectation of investors become high. So they are expecting higher returns as compared to other safer instruments. Now, some more examples of equity fund could be diversified equity fund, focused equity fund, sector funds, all those. Now, let's come to debt fund, the fund that invests in debt and debt related instruments. So major proportion of the investment amount, which will be more than 65%, will be invested in debt and debt related instruments. And as you know, compared to equity, debt instruments are more safer. They are less riskier, and hence, because they are having less risk, returns are also lower. But as I told, these are safer instruments to invest. Now, some of the debt schemes are liquid fund, money market fund, overnight fund, short duration fund, bond fund, gilt fund, etc. Giving you a brief about liquid fund is an open-ended liquid scheme which invest in debt and money market securities with maturity up to 91 days. Then in the same way, the overnight fund, these schemes invest in overnight security which is having maturity of 1 day. And likewise, gilt fund, they invest majorly in government securities. So you can see that these funds are for shorter duration and in more safer instruments with an average return. So those will be considered as debt funds. Then there is hybrid fund. These funds invest in a mix of equity and debt instrument. Now there are people who want to take a balance between the both. So they don't want to go for higher risk and they don't want to compromise with lower returns. So they want a balanced fund. And thus there is hybrid fund, which is a mix of equity and debt instrument. So here there will be investment in proportion in both the asset classes. Now this can be further categorized as conservative, balanced and aggressive hybrid fund. So conservative hybrid fund, where investment in debt instruments will be about 75 to 90%. Then there is balanced hybrid fund, where the investment in both equity and debt will be almost equal, about 40 to 60%. And then aggressive hybrid fund, where the investment in equity instruments will be on larger side. So it will be about 65 to 70% and rest will be going in debt instrument. Now let's come to classification on basis of goals. So first is tax saving fund. Now you can also choose the mutual fund scheme according to your investment objective. So maybe you want to invest in that kind of scheme which will also provide you with tax saving option. You don't want to end up paying a lot of taxes. So mutual fund offers tax saving schemes which provide tax benefit to the investors along with return. Now the investment made in tax saving mutual funds are eligible for tax benefits under section 80C of the Income Tax Act. So there are many tax saving funds available which will provide you tax benefits, which will be tax deduction under section 80C of Income Tax Act. And one such example of tax saving fund is ELSS, which is Equity Linked Savings Scheme. Second is retirement fund. The fund invests majorly in low risk investment options like government securities to ensure stable and steady return. Now, if you want to save your money for your retirement, you want that you have invested your money over the time and after retirement, you reap the benefits in form of pension from that particular fund. So you can invest in retirement fund. These mutual fund schemes invest in safer instruments like government securities so that your money is safe and there is no loss and you would be provided with a good average return to provide you pension after your retirement. Now investors invest money in retirement funds so that they can receive regular money as pension after retirement. Generally, the retirement funds comes with lock-in period of about 5 years or till your retirement age as per your choice. Then there is growth fund. Growth funds invest in diversified portfolio consisting of stock of high growth companies. The main objective of these funds are to provide capital appreciation. Thus, they provide little or no dividend. These funds are high risk instruments with high return potential. So growth funds will not be providing you any dividend or will be providing you very little dividend because most of the money is reinvested. The major objective of growth fund is capital appreciation. So to provide you as higher return as possible. Now these funds will thereby taking higher risk and will be investing in diversified portfolio consisting of stocks of high growth companies or companies which are new but are having high growth potential. So these funds are high risk instruments and thus the expectation of return is also high by the investors. One such example is blue chip fund, which invest in most of the growing companies, most of the popular companies. Then there is fixed income fund. These funds invest in safe assets like bonds, debentures, and money market instruments to provide regular cash flows at defined interval to their investors in terms of interest and dividend. So these are the funds which will be providing you regular cash flows. Some people want to invest so that they can generate money at regular interval of time. So these will be fixed income fund. They will be investing in short duration bonds, debentures, money market instruments, and will be providing their investors in the form of dividend or interest regular cash flows. So one such example of this fund is monthly income plan. Now let's see categorization based on risk. So first is low risk fund. Now this categorization is dependent on your risk appetite. Maybe you are an investor who is a risk averse. It means that you don't want to take higher risk because you are fearful that your money will be lost and you can't take that much of risk. You are having a family to care of and you're not having so much of investable amount to lose, and thus you will be going for low risk fund because these funds will be mostly investing in debt instrument. These are debt oriented fund with low risk, and thus these will be safeguarding your invested money and will also be providing you a good average return of about 6 to 7%. Now because you are taking lower risk, obviously your money is safe and you are getting an average return which is generally low, about 6 to 7%. But anyway, your investment objective was to get an average return, but to be on the safer side and to take lower risk. So examples of low risk fund are gilt fund. As I already mentioned, these fund invest in government securities. Then there are debt fund investing in debt instruments. Then there are money market fund which invest in money market instruments like call money, certificate of deposit, treasury bills, etc. Then there is moderate risk fund. These funds provide a balanced composition of investment in both equity and debt with moderate risk and return of about 8 to 10%. So there are people, I talked about the investors who are ready to take some amount of risk but are not ready to take a lot of losses, and thus they will be going for moderate risk fund because these funds invest in a composition where there is a balance between both the equity and debt funds. Now this because some amount is invested in equity instruments, some amount is invested in debt instruments, it provides a moderate return of about 8 to 10%. Some of the example of moderate risk fund will be hybrid fund, conservative fund, balanced fund, etc. Then there is high risk fund. Generally these funds are chosen by the youths which are not having dependents and they want capital appreciation growth in their money, so they will be investing in high risk fund. These funds invest majorly in equity and equity related instruments with the major investment objective of growth and capital appreciation. Now as we saw that whichever fund is investing in equity majorly, they are having higher risk, and thus the expectation of return by the investor will be on higher side, but it's not sure that you will be provided with higher return. It is largely linked with the market. So if the market will be in favor, you can expect a good return, but if the market will be going down, you will be incurring losses as well. So it is recommended that whenever you are investing in high risk fund, whenever you are investing in equity fund, which are largely investing your amount in equity and equity related instruments, you should invest for a good time period. So that should be around 5 to 10 years because that time period will be required to go through all the market fluctuations and thereby give you a good return, because market fluctuations in shorter time will not be providing you a good average return. Market may be down or it may be going up and again it may come down. So the market fluctuates, but over a period of time it will grow and it will provide you a good return. So it's always advisable to invest for the longer period of time when you are investing in high risk fund, equity fund. Now categorization based on specialty. So first it's sector fund. This is an open-ended equity scheme investing in a specific sector such as bank, power, infrastructure, pharmaceutical, technology, real estate. So these funds will be investing in one particular sector. So if you as an investor, you see that banking sector is performing really well. So you want to invest in sector fund which will be investing in banking sector. So these sector funds will be choosing one particular sector and will be investing in that sector only. Now, these sector funds are thus riskier because if that particular sector in which investment is done does not perform well, loss will be significant. So, it's not diversified. All the investment is made in one particular sector. If that sector collapses, your money will be lost. But if that sector is performing really well, it is booming, it will provide you very good returns. That sector fund is riskier, but it needs to be concentrated how that particular sector is performing and how that will be performing in the near future. Then there is thematic fund, an open-ended equity scheme investing in line with an investment theme. So these mutual funds will be investing according to theme. These funds invest across multiple sectors that are woven around a common theme. So thematic fund is generally confused with sector fund, but it is different. Sector fund will concentrate on one particular sector, while thematic fund will concentrate on multiple sectors which will be related to that particular theme of that particular mutual fund scheme. So for example, an infrastructure thematic fund might invest in shares of companies that are into infrastructure, construction, cement, steel, telecom, power, etc. So the theme of that mutual fund scheme was infrastructure. Now that according to that theme, the mutual fund scheme will be investing in shares of all those companies which are somehow linked to infrastructure business. So it will be construction, the cement, the steel, the telecom, all that is linked to infrastructure. Fund of funds, an open-ended fund of funds scheme investing in an underlying fund. So in simpler terms, these are those mutual fund scheme which will be investing in other mutual fund scheme. So one fund investing in another fund will be referred as fund of funds. The minimum investment in the underlying fund shall be 95% of total assets, which is quite a large amount. Thank you for watching. Do like and share my videos. Subscribe to my channel DevTech Finance. Thank you all.